Welcome back to Factful Finance, where we break down the world of money, investing, and financial freedom in ways that make sense. No jargon, no confusion, just straight talk. Today, we're diving into a question that's critical for anyone starting out on their investing journey: how to manage risk when you start investing. Now, here's a quick fact to get you thinking. According to a 2023, 75% of new investors say they're afraid of losing money. But here's the kicker. Managing that risk is not about avoiding it altogether. In fact, risk is a fundamental part of investing. The key is understanding it, controlling it, and using it to your advantage. Before we jump into the practical tips, a quick disclaimer. This video is for educational purposes only. While we're diving into investment strategies, always remember that consulting a financial advisor can give you personalized advice based on your specific situation. So, how do you manage risk when you start investing? Let's break it down with 3 key strategies. First up, diversify. Diversify, diversify. You've probably heard the term, but let's break it down. Diversification is about spreading your investments across different assets to reduce the impact of any single investment's performance on your overall portfolio. For example, let's say you're considering stocks. Instead of putting all your money into one company, you could spread it across several sectors: tech, healthcare, energy, and even some bonds. This way, if one sector takes a dip, others may still perform well, cushioning your losses. Take Noah, for instance. He's just getting into investing, and he starts with $5,000. He puts $1,500 in tech stocks, $1,500 in healthcare, and the remaining $2,000 in bonds. Even if tech stocks take a hit, his bonds and healthcare stocks could still keep his portfolio relatively stable. Next, we've got understanding your risk tolerance. This is a personal one. What level of risk can you live with? Are you comfortable with the idea that some of your investments may go down in value in the short term, but could go up significantly over time? Or do you prefer to keep things safer, even if it means slower growth? Let's look at a practical example. Olivia, who's 25 and just starting to build her portfolio. She's willing to take on more risk because she's got decades before retirement. So she invests more heavily in stocks, knowing they can be volatile in the short term, but offer higher returns over the long run. On the other hand, her cousin James, who's 50, has a more conservative approach. He focuses more on bonds and dividend-paying stocks, which offer more stability. And finally, we can't talk about risk without mentioning emergency funds. Think of it as your financial safety net. The idea is simple. Before you even begin investing, you want to have enough saved up in case of an emergency, so you don't have to sell your investments at a loss just to cover unexpected expenses. Most experts recommend setting aside 3 to 6 months' worth of living expenses in an easily accessible account. Let's imagine Liam, who decides to start investing with $10,000. Before diving into stocks or bonds, he makes sure he has $3,000 in an emergency fund. This way, if something unexpected happens, like a job loss or a medical expense, he doesn't need to panic sell his investments. To wrap up, let's recap these strategies. 1. Diversify your portfolio to spread out the risk. 2. Understand your risk tolerance to match your investments with your comfort level. 3. Build an emergency fund to protect your investments from needing to be sold prematurely. What's the first step you'll take to manage risk in your investments? Drop a comment below. I'd love to hear how you're planning to approach risk in your investment strategy. And as all for watching. If you like the way we break down personal finance topics, why not subscribe and click that bell so you don't miss out on the next video? We think you'll enjoy the one coming up next. It's packed with valuable insights to help with your financial goals. Take care, and remember, smart investing isn't about avoiding risk, it's about managing it effectively.